If there was ever any doubt which markets mattered most to policymakers and to global economies, we know now for certain it is not the stock market. It is in fact the bond market, which has been showing signs of extreme stress bordering on breaking recently, which is why you need to watch out for the Federal Reserve bailing out the bond market at some point very soon. Jamie Dimon, the CEO of Chase, recently said that he expects a kerfuffle in the US Treasury market that will prompt a Federal Reserve intervention. Now, a kerfuffle in this case means the entire bond market breaking, liquidity seizing up, and somebody big about to go bust, go out of business. Something like Lehman Brothers. That's what Dimon means by kerfuffle here. He doesn't simply mean, oh, the 10-year goes up a little bit and government financing gets a little bit too expensive. Kerfuffle means something catastrophic that, if it's not dealt with, could take down the global financial system. Otherwise, that would not prompt a Federal Reserve intervention. He goes on to say here that the expected turmoil is because of all the rules and regulations, and that he believes the Federal Reserve will only step in when they start to panic a little bit. Again, this is not going to be something from Treasury prices falling a little bit. This is going to be something catastrophic, something along the lines of September of 2019. You remember when the Federal Reserve had been allowing their balance sheet to decline, and then suddenly they reversed course and called it not QT. Well, what has the Federal Reserve been doing recently? They've been allowing their balance sheet to decline. When the Federal Reserve's balance sheet goes up, that's called QE. They're injecting liquidity. The opposite is true as well. When the balance sheet goes down, they're withdrawing liquidity. This is one of the many factors that has contributed to interest rates on government debt going from so low to so high over the last couple of years. And the lack of liquidity in the system is starting to show through, with cracks forming, evidenced by the 10-year yield moving from 3.88% all the way up to 4.58% in the matter of days. A big thing happening here is the unwind of the basis trade, which I've talked about in a recent video already. Go back and check that out if you haven't seen it yet. But an underlying issue below even that is the liquidity in the plumbing of the financial system. When financial institutions need to go get cash, they need that cash to be there available to them. In September of 2019, financial institutions went to go get cash and it was not there. They do this primarily through the repo market. Overnight, they go to other financial institutions and say, hey, I've got some treasuries. Can I have some cash? Normally that works fine until everybody goes with their collateral, the treasuries, tries to get cash, and there is none. That's why the Federal Reserve had to step in and provide that liquidity themselves, which is why their balance sheet started increasing again. This is the type of thing that Jamie Dimon is talking about when he says he expects a kerfuffle that will make the Fed start to panic. Now, he also said that this is due to all the rules and regulations that financial institutions face today. And part of this is true as well. When financial institutions do something that people don't like, governments come in and say, you can't do that anymore. But those financial institutions will then say, okay, we need to find ways to make money still. So within the rules that we have set, we're going to find different creative ways to make money. Usually that involves levering up on those things that are still allowed, which causes hidden risk in the system that blows up all at once. Now, this last piece that Jamie Dimon said is something that I've been predicting for a long time, primarily because people like him are talking about trying to make it happen. He is advocating for bank rule change, including exempting treasuries from the supplementary leverage ratio in order to avoid a repeat of the 2020 treasury market seizure and allow banks to become more active intermediaries in markets. Right now, banks are restricted on how many treasuries they can buy. They hit their risk limits because treasuries can go down in price, which is what happens when yields increase, which means if the bank has to sell that treasury, they might be selling it at a loss. Now you say, wait, treasuries are supposed to be risk-free. As long as they can hold on to them until maturity, there's no risk, right? You're absolutely right. But that as long as they can hold on to them until maturity piece is a really big piece, because if there's a bank run and everybody tries to get their deposits back, well, the banks have to sell the assets that they have to free up the cash. And if those assets are worth less than when the bank bought them, then they're out of luck. And so one restriction that was placed on banks was how many treasuries they're allowed to buy in the first place. So making this rule change would absolutely allow banks to buy more treasuries. But it doesn't solve the issue all by itself. You would also need an explicit or at least an implicit guarantee by the Fed that if something were to happen in terms of a bank run, that the bank could temporarily sell those treasuries to the Fed for full price. So the Fed could hold on to them until maturity, or the bank could purchase them back from the Fed at a future point in time. Now, do we have any recent history, any precedent being set for the Fed doing this? Why, yes, I'm glad you asked. Over the last couple of years, the Federal Reserve established something called the Bank Term Funding Program, specifically in order to allow the bailout of banks like Silicon Valley Bank, so that any banks that had treasuries that had unrealized losses on them could temporarily sell them to the Fed, buy them back later. Now, this program has been shuttered for now, but they could always bring it back, which means that treasuries could basically be viewed as reserves for banks. And that's exactly what banks and their executives like Dimon are pushing for. And it seems like the Federal Reserve is aware that problems are going to pop up soon that will require their intervention, because you're seeing headlines like this where the Federal Reserve has stated they are absolutely ready to stabilize the market if needed, and that they are prepared to act with various tools. Now, the other important piece here is that it's not just the Federal Reserve. When you take a look at the Treasury under this new Trump administration, it's led by Scott Bessent, who has made it very clear that the only priority here is a lower 10-year yield, which as of right now, this administration has accomplished the exact opposite. But it still could lead to getting their end result if it forces the Federal Reserve to bail the system out. If the Fed has to return to an emergency QE program and buy up a bunch of US Treasuries, that could absolutely send the yields on government bonds plummeting and the prices of those treasuries soaring. So a temporary hiccup like this may not actually be something that is putting a permanent dent in their plan. In fact, it may be a necessary step along their way to get those rates lower. Because let's be honest, with all of the spending, and yes, this administration, I'm talking about spending increases despite what Doge is doing, and the proposed tax cuts, the free market is not going to be lowering these interest rates for the government by themselves. It's going to have to come with some central intervention. And it's not even just Scott Bessent here that cares about the yield on the 10-year. It's President Trump himself. He explicitly stated during this recent round of tariffs being implemented and then being paused that the reason he paused tariffs was not because the stock market was falling. It's because he said he was watching the bond market and he could tell people were getting queasy. He has also recently begun tweeting at the Federal Reserve again, telling them that they need to be lowering rates. And well, we've seen this game play out before and we know how it ends. From a growth perspective, it makes sense why you'd want to focus on the 10-year, because if you can get the 10-year lower, that means lower mortgage rates, that means lower credit card rates, that means lower auto loan rates, that means lower financing costs for business and corporate debt, which is simply just more spending stimulating growth. It's fuel to the fire of an inflationary deleveraging and a credit boom, but it still shows up as growth nonetheless. So because of that, personally, I would not bet against it, which means that this bear market we're looking at in the stock market is on borrowed time. It is almost done and over, which means the sales that you are seeing on some of these stocks that are some of the world's best assets to own are sales that will not be lasting that much longer. And if you don't know how to take advantage of it, how to filter the companies, the good ones from the bad ones, how to calculate what is actually a sale, how do I know if this company is actually trading at a discount to its intrinsic value? If you don't know how to do any of that, you need my bear market investing guide. I've made it just for time periods like this one, and it's only going to be on a crazy sale until this bear market is over. By then, it's too late. If you're interested in building your fortune while there's blood in the streets, go ahead and get that linked in the description below. As always, thanks so much for watching. Have a great day.